Welcome to this explainer. Today we are doing something pretty exciting. We are literally diving into the ultimate wealth building playbook. We've taken the core wisdom from 66 personal finance, economics, and investing books, and we've boiled it all down to the 14 absolutely crucial lessons. Think of this as your definitive roadmap to financial independence, designed specifically for those of us who just want to skip all the noise and focus on what actually works. Now, I want you to completely forget about chasing a standard 8% stock market return for a second. We're going to start by revealing a mindset and an investment strategy that is actually capable of yielding a staggering 10,000% return. Yeah, you heard me right, 10,000%. Most people out there are fighting tooth and nail for a tiny fraction of a percentage point in their portfolio, and they are completely ignoring a massive opportunity that's right in front of them, one that scales exponentially. So, to get us there, we've organized these 14 lessons into 4 distinct phases: redefining wealth, the action plan, the long game, and defending your wealth. Let's kick things off with phase 1, redefining wealth. And this brings up a really fascinating question. If you were a stock, would you invest in yourself right now? Think of yourself as a company. You're either growing or you're dying. So instead of throwing your very first $1,000 at Bitcoin or real estate, our sources actually suggest putting it into the one asset that's capable of that massive 10,000% return. And that asset is you. We all want to invest in companies that are innovating, right? So you've got to ask yourself, are you actively growing? And honestly, investing in yourself is surprisingly straightforward. It goes like this. Pick an in-demand skill that genuinely interests you, grab a course on Udemy, dedicate just 20 minutes a day to it, literally just 20 minutes, and then apply it in the real world through freelancing or maybe an internship. That is exactly how you drive your own stock price up. Now, this next concept frames our end goal perfectly. Your immediate objective, it actually isn't getting rich. It's achieving financial freedom. That means generating enough passive income to cover your basic expenses so you literally never have to work another mandatory hour again. Imagine renting out an expensive apartment in a costly city and then moving to a cheaper country where that rent just covers your entire lifestyle, the whole shebang. Once you buy back your time, actually buy it back, then you can focus on building that excess wealth to free your grandchildren. But as you're building toward that freedom, you really have to remember that time is money. What is the actual return you get on 1 hour of your time? Don't be that person who waits in a massive line for a full hour just to get $2 worth of free ice cream. Or similarly, if you invest in some volatile asset and spend days stressing over price drops, endlessly watching prediction videos, you're just bleeding valuable time. You always need to evaluate the hourly return on your life, not just the financial return on your dollar.
All right, moving right along to phase 2, the action plan.
This illustrates a super common trap we all fall into: sweating over complex bond ratios just to squeeze a $100 return out of a $1,000 portfolio. It makes absolutely no sense if you're simultaneously going out and blindly blowing $100 on drinks in a single weekend. Look, a multimillionaire actually has to stress over a 10% drop because that costs them $1 million. But when you are just starting out, you need to stop overanalyzing the investments and start analyzing your spending.
Now, you might think you need some massive reas to start investing, but the math shows it only takes finding a groundbreaking $3 a day. Seriously, $3. Whether it's bottled water or that daily coffee habit, most of us could easily trim $3 a day to fund our future without even feeling the pinch. Think about it. If your pay was cut by 5% tomorrow, you would adjust and survive. You can easily cut $3 today.
But here's the catch. You absolutely cannot rely on willpower to save those $3. As Barry Schwartz explains in The Paradox of Choice, when we're faced with too many options, we just freeze. Manually choosing to transfer money into savings every single paycheck, that's a painful, active decision that sets you up for failure. The secret here is automation. You must automate your finances so the money moves the second you get paid, completely removing your future self's ability to mess it all up. It's really fascinating how we put our money into these little psychological boxes. We'll cheer a $100 crypto gain while completely ignoring the $150 we're bleeding in loan interest every month. Looking at your finances holistically is absolutely crucial here. Paying off a 15% interest debt is mathematically identical to finding a guaranteed, spectacular investment that pays a 15% return. Pay that debt off first. And that brings us to phase 3, the long game. Okay, take a close look at this. If you invest just $100 a month starting at age 25 up until age 35, and then you stop completely, you remarkably net $50,000 more by age 65 than a friend who starts at 35 and invests for 30 straight years. No way, right? But the heavy lifting is all in the timing. Every single year you delay makes it exponentially harder to catch up.
So, the really crucial takeaway here is that you do not need to be perfect when you invest for the long term. In fact, you can be wrong most of the time and still win big, thanks to the 80-20 rule. Heinz Berggruen built a legendary art collection simply by buying in bulk. Most of it wasn't super valuable, but a tiny percentage was priceless. Even Warren Buffett has owned shares in over 400 companies, but his astronomical wealth came from just 10 of them. Accept that failure is just part of the process. And this right here is exactly why the overwhelming consensus across all these books points straight to index funds. It's not about picking the next hot stock, it's an automated, low-cost bet on humanity itself. Think about a massive global fund holding thousands of companies. I mean, in the 20th century alone, we survived 2 world wars, a Cold War, massive economic crashes, yet humanity kept right on developing. An index fund is simply you betting on our continued progress and survival. Finally, we arrive at Phase 4, defending your wealth. Let's look at what is probably the most dangerous trap of all, hidden fees. The financial industry loves to tell you a 1% management fee is practically nothing, but check this out. If your grandma gifts you and your brother $100,000 and you both get an 11% return, but his fund charges a 1% fee while yours charges 2%, well, over 30 years, that seemingly harmless 1% difference vaporizes over $400,000. That's nearly a quarter of your potential life savings gone. Always, always pay attention to the fees. Next up, you need to be highly suspicious of the statistics pitched to you, specifically the danger of averages. Let's call it the Elon Musk effect. Imagine you and 2 friends are sitting in a car, and you each make $10,000 a month. The average salary in that car is $10,000. But if one friend steps out and Elon Musk gets in, the new average salary in that car suddenly skyrockets into the billions. It's incredibly misleading, so always look under the hood when a fund ghosts about its average returns. Defending your wealth also means checking your own greed. We naturally want shortcuts, right? But once greed takes the wheel, you start ignoring facts and believing in magical, guaranteed returns. Truly successful investors are actually remarkably conservative. They build wealth systematically rather than jumping into scams. Basically, if a promise defies the math we've just been looking at, you need to step away. And when you're out there seeking advice, ask yourself this: do these financial experts eat their own cooking? Be incredibly skeptical of financial advisors who are eagerly handing you a glossy brochure for a mutual fund. If an opportunity is truly spectacular, the experts keep it in-house. The absolute best opportunities, like a prime underpriced piece of real estate, are bought up internally by the agents themselves. Always question whose interest that glossy brochure is actually serving. So as we wrap up this explainer, I want to leave you with a final thought to audit your own financial life today. Are you going to keep treating your money like lottery tickets, just endlessly chasing the next spike for a quick exit? Or are you ready to actually invest in your own skills, eliminate that high-interest debt, automate your habits, and finally buy back your time?